The first two, liquidity ratios and capital structure and long-term solvency ratios, are so-called balance sheet ratios because all, if not all, the vast majority of figures used to calculate these ratios come from balance sheet. So let's have a look how they are classified. And now we continue. Ooh, this is a hard story. Therefore, I sipped a bit of black tea because we have now these balance sheet ratios that we have today to talk about. And there's quite a number of them because you could produce any ratio you want. But these that are listed here, current ratio, quick ratio, cash ratio, debt to equity ratio and gearing, proprietary ratio, and some others, are the most important. I would say that first four lines are absolute must. We as financial people, we have to know them like this. We wake up and we know. They are so important. Current ratio, quick ratio, cash ratio, debt to equity ratio, DE ratio, in other words, or gearing. Ooh, now it is the first one. Current ratio. It's a tool to evaluate short-term solvency position of a company. In other words, how good is the company with money, with cash in short term. Therefore, it's current ratio. Short-term solvency refers to the ability of a business to pay its short-term obligations. Short-term obligations, also known as current liabilities, are the liabilities payable within a short period of time, usually under 1 year. And this famous current ratio is current assets divided by current liabilities. Current ratio is current assets divided by current liabilities. There is this ratio shows very well how the company is able to pay its current liabilities because it should be covered somehow by current assets. But again, as any ratio, there are some limitations, comments, and other things. And different ratios may be in different parts of the year because, this is important, there are companies that have different trading activities in different seasons. Say you are the farmer, right, and you have wheat. I know European example. And wheat is harvested somewhere, say the beginning of August. So most likely, most farmers will have a lot of cash in September when they sell their crop. And most likely they will have very little cash in the spring. And so in some months of the year, this current ratio might be high and some might be low, depending how we count it. Then change in inventory valuation. This is important because we always have to know how a company valuates, because inventory as well has to be evaluated in a proper way. And if, say, the rules of this valuation, for example, there is a change in method of valuation of the stock from FIFO to LIFO or other way around, this may result in different valuation of the inventory. And this would be with a result on our current ratio. And then there is a sort of easy possibility of manipulation. Current ratio could be easily manipulated, look at this, by equal increase or equal decrease in current assets and current liabilities. For example, If current assets of a company are 8,000 and current liabilities are 4, the current ratio would be 2 to 1. Actually, it would be 2. Yes. If both current assets and current liabilities are reduced by 2,000, yes, then it will be 6,000 divided by 2,000, and then the ratio suddenly increases to 3. Difference? So it's easy to show and to cover some things in the ratios. And as well, current ratio may be misleading in some other circumstances, like paying from debt, because companies might implement this line of credit that they have in order to pay. So, therefore, their cash balance is almost near to zero. Actually, they have quite small number of current assets because they are able to borrow on line of credit from the bank. And as I said as well, current assets are sort of tricky because they may have a lot of inventory or stock, and as such they may be sometimes very difficult or even impossible to liquidate. Therefore, current ratio has some hidden disadvantages. So, now we are back to current ratio. We remember current assets divided by current liabilities. And then there is a question, so how much is a good number? Yeah, this is a very important question. We divide and we have a number 10 or a number 0.5 or something like this. So then what is the good number? The answer is that this is a test of short-term debt paying ability. So if the debt has to be paid, this all amount of this current assets should be significantly higher. Therefore, the ratio 2 to 1 means 2 is considered satisfactory for most of companies. But when you analyze, then you have to be very, very prudent or very specific about what you do. Because if there is a company, for example, that has very slow moving, means that they are on stock for a very long time, the inventories, or obsolete inventories. This is obsolete means you cannot sell them, or it's very difficult to sell, or if you sell, it will be with a huge loss. So these slow moving and obsolete inventories, even if company has a very high current ratio, because maybe in the book these inventories are worth quite much money, then even with a very high current ratio, company may not be able to pay its current liabilities, unfortunately. However, if the company has a very large portion of current assets made of highly liquid assets, then even with low current ratio, a company may be able to pay its current obligations. Sorry. Therefore, we have to be prudent with current ratio, but figure 2 is okay, generally. But, as you probably might think, if we have some problems with current ratio, perhaps there is another ratio that might help us in clearing the doubt about the current ratio. And then we come to another wonderful tool, and this wonderful tool is called quick ratio. Sometimes people call it in slang acid ratio or acid test. Yeah, okay. Now, acid because in very past times when people wanted to check gold, they poured acid on gold, and if it, on the metal, and if it stayed like this, probably it is gold, so because it does not react with majority of acids. So acid ratio or acid test or liquidity ratio. And now, quick ratio is used to test the ability of a company to pay its short-term debts. Okay? It measures the relationship between liquid assets and current liabilities. Again, some definition may be unclear, what's liquid, what's not. Therefore, let's be clear what we think about liquid assets. Obviously, many authors may have different opinions, but generally liquid assets, majority of people and I think that current assets minus inventories and prepaid expenses. Minus inventories, because you remember this was the major problem with interpretation of the current ratio. Because if there is a lot of inventories, then probably this current ratio does not have so much informational value. Therefore, we take out inventories and prepaid expenses to have liquid assets. Other way around, you could find a number from the balance sheet by deducting something, like current assets minus inventories minus prepaid expenses, or you could do it other way around by adding something. So what is liquid assets? Liquid assets are cash plus marketable securities plus accounts receivables. And what you have on your account or in cash plus some commercial papers or securities that you could quickly sell, and this what you expect to receive in your business from your business partners as price for your products. And so these liquid assets are divided by current liabilities. This what company has to pay within a year. And if so, then we could make another deeper analysis, because quick ratio is considered to be more reliable test for short-term solvency than current ratio, because it shows the ability of the business to pay short-term debts immediately, almost immediately, because it matches actually the most the most easily liquidated portions of current assets, what you could just as quickly as possible have in cash or convert it to cash, and it matches this with current liabilities. So it gives an answer for, has the business sufficient assets immediately convertible into cash to pay its bills? And as well, it's considered to be more reliable test for short-term solvency because it excludes these inventories. Why? We mentioned something before, but now it's time to underline, because it takes time generally to convert inventories into cash. It's not easy to sell stock, because if it's a large stock, probably you had already some problems to sell it. So if you had some problems to sell it, then it's difficult to sell it at all. And if you sell it finally, your inventories, it may happen probably with a loss. Or in even worse scenario, it's impossible to sell, so it will be a write-off, means value zero. Just completely impossible to sell. And as well, it excludes prepaid expenses, because in a sense, when they are prepaid already, you don't have this cash because you prepaid something, so you don't have the cash. And if you don't have this cash, you cannot possibly pay your current liabilities with this prepaid expense. So these are all these interesting things about quick ratio. And to underline again, sort of to maybe to release the pressure from your heads, this is another very nice cartoon of a very nice slim lady and a gentleman with a large belly, and he says, "You call it a beer belly. I prefer to think of it as a lump sum settlement of liquid assets." Obviously, it's a kind of a cartoon joke. But what is the good number for quick ratio? Again, we have to find a good number because it's as well a very good test in all kind of manufacturing, retail, any businesses that inventories could be largely important, because if not, then the current ratio would be okay. But again, it's very important from the point of view of an entity who is in relation with you about money. So, creditor or lender, they are with you in money. And a quick ratio, 1, means 1 divided by 1. So 1 is considered as satisfactory. So 1 is okay. However, if the company has very fast moving inventories, this may improve liquidity position of a company with a low quick ratio. Let's say quick ratio is relatively low, but the company turns inventories very quick in a matter of days. Maybe it's a very interesting retailer who does this. Again, in quick ratio, when slowing paying debtors exists in the company, because we have the receivables in that, then it weakens liquidity of a company, even if this quick ratio is substantially higher. And quick ratio may still not yield a good view of immediate liquidities if current liabilities are payable right now, while receipts from receivables are not expected for several more weeks later. So even with high quick ratio, high or satisfactory, it may not be enough in the analysis of the company if there is a discrepancy between the time your current liabilities are payable right now or very soon, while some part of your liquid assets as receipts from receivables will come in at the much later time. Now we come to cash ratio, which is the third most important of liquidity ratios, and it's called as well absolute liquid ratio or liquidity ratio. However, most of people would just say cash ratio, and everybody would know what it's all about, because this is called by some very sophisticated way absolute liquid assets, because they are absolute liquid assets, but what they are cash and cash equivalents. So say they are cash. So cash and cash equivalents divided by current liabilities. And already we will say that 0.5 divided by 1, so it means 0.5, is considered suitable for most of the companies. What are they listed absolute liquid assets. They are liquid assets minus accounts receivable, including bills receivable, such as, so what's left? Cash, hard cash, bank balance, and marketable securities. You remember, probably, I will just go back to this point, that in quick ratio it was, say, maybe not better, but sometimes more precise as a current ratio, because in quick ratio we had cash and marketable securities, sort of cash equivalents, and accounts receivables. We did not have these famous inventories that may cause some problems in case of current ratio. But now, when we talk about quick ratio, we might say that, as it's here, that these receivables are as well some kind of a problem, because we never know how long time will it take till we are able to collect these receivables. And if so, perhaps by taking them out of this numerator, then we will have better, or sort of a different angle positioned ratio. So in fact, in cash ratio, they are taken out. So what's left? Left cash and cash equivalents. And as Brilli-Myers, they explain it well in their books. I think personally that Brilli-Myers might be the best book about corporate finance. They say that cash ratio eliminates account receivable from the list of liquid assets because their rapid collection may be difficult. So it is better than quick ratio in short-term analysis. So we have this three: current ratio, quick ratio, and cash ratio. And cash ratio concentrates purely on cash divided by current liabilities. But again, if it's so good, in some cases it is so bad. I'm sort of joking, possibly to wake you up, because if we throw out, we have the good quick ratio, and then we think maybe not so good, so we eliminate receivables to have cash ratio, it may be too conservative, because these receivables may be easily convertible into cash. The product that company sells is easy to sell, and it's sold in large quantities and in a predictable way. Then these receivables are easily convertible into cash. Then, if the company is listed on a stock exchange, it has to produce the figures, and obviously it's publicly known to the outside world. And the company might know that, okay, we are doing fine with our high or good quick ratio, we are paying everything on time, brilliant, but we just keep low amount of cash because we just do not need this amount of cash. But because these results are presented to the investors, to everybody in the world, then a very low cash ratio may be not perceived very well. Therefore, the company keeps more cash than it's prudent. And it may happen as well, it's not written here, that the company as well, for example, keeps quite a number of cash because it generates cash and does not have the idea to put this cash, and they accumulate the cash for cash purchase of a competitor or a location or something like this. And again, sort of the weak point of cash ratio might be that the cash ratio only measure cash balances at a specific point of time because it's balance sheet derived ratio, so at a certain point of time. And because it's about cash and current liabilities, this particular relation, in particular about cash, may change very quickly, because if it happens that liabilities are paid on short term and receivables are collected on short term, and then it's converted into cash in short term, it may vary from day to day even. So, as a prudent and very recommendable idea, I would say always use 3 in analyzing a company. Always use 3 in conjunction: current ratio, quick ratio, and cash ratio. Remember which levels are considered to be good, and just please analyze them in your head. As I said, I strongly believe in ratio analysis, but as well there is a number of limitations or comments or conclusions. So firstly, if the data from financial accounting, from financial statement is incorrect, the whole analysis will be incorrect. As simple as that. So we have to trust the accounting information. Like, we are investors, so it's like publicly made information, or we take information from our accountants. We have to trust them, that it's properly done, and then our analysis could be reliable. Then, because if the data is done by accountant and still, for example, not audited, it as well could be some misinterpretation of ratio analysis. I warned you once that a single ratio does not give the whole picture. There must be a couple of ratios from different perspectives, from different groups to analyze the company. Because a single ratio, okay, gives a first glance, but not will be the answer if this investment is a good one or not, if we are investors. And then there's one important thing that we mentioned sort of slightly, that we use this analysis in consecutive years from the past. So as such, we deal only with historical data. We just do not touch future at all. We don't say about expectations, forecasts. Of course, you could do the analysis of the forecasts as well, of course, but they are only forecasts, only predictions. So what we do is the historical analysis, historical data. And if we do the future predictions, it's based on the past performance. And we never know if the past performance was the good one enough for the future, or maybe it was exceptional, it will never be again like this. You never know. You have to use your own thinking in interpretation. Again, if we do like long-term analysis and we have some trends, if there are strong variations of the price level of certain goods and products, this is, for example, like in copper mining industry. They dig copper normally, substantially, all the time. Like, they have the assets, they have the copper mine, and they dig it, they sell it. There is a demand, but price of copper goes up and down. So as well, the rentability ratios, for example, they will be all different and possibly distorted. it's again very important to use, to underline that if we compare year after year in one company, we have to know that the accounting principles and policies are the same. As well, if you compare the data from different companies, you must be sure that their accounting principles, policies, laws, regulations are the same. Because if you do not do it, then the comparison is not clear. And this is very important. When we do this analysis of ratios, we never know if there was a special event, special catastrophe, or special winning, or special insurance be paid. Plenty of things like that. There is as well leasing that is off balance sheet. There's plenty of things that you have to put into full analysis of the company. As I mentioned, the copper industry, when you do the ratio analysis of a certain company within certain industry, then it's very useful to have the knowledge about this particular industry, how it operates, what is important. Maybe they have sometimes much longer periods than 1 year of investment, of return. And you have to be an expert. I mean, if you give the ratio to somebody who does not understand this, but you are the experts, you are outstanding students. So brief summary of what we have done with ratios. Brief, just in a bullet. That ratio analysis is an activity that uses financial information to help managers to run the company. Yes, these are the indications. These are just some figures, just some numbers. And when you know how to interpret them, you know basically how to run the company. And because we use the data from the financial statements, and we use basically balance sheet and profit and loss account, and we know that the balance sheet is a proper picture of the company, like a photograph, but only on one point of time, on a yearly basis, the most likely. So we have to remember again that something might have happened in between these dates. Quite a lot of things happen, but we have to judge which of them are normal operating business of the company and which of them are exceptional. And as such, we have to treat them exceptionally to take it in account how we interpret ratios. But if we, on sort of daily basis, daily maybe not, but sort of on regular basis, we are analysts, say, in an investment company, and we, on current basis, we analyze companies, and many companies, many companies, even from the same industry. It's a wonderful tool to effectively analyze and quickly analyze companies, because you just do the number and then you know how to interpret the number. And again, as we noticed, we mentioned there's variations of the ratios and weighted average concept of ratios, that we have to be sure that we prudently use them in consistent way according to the industry and according to businesses. You really need to know when to use the weighted average and when not. Or if you have the subtleties in variations, why you use certain variation, what for. And the final word is that, when you analyze the company, we use just balance sheet and the profit and loss account. But there may be many other things, like investing in new areas, new businesses, new countries, changes in management, changes in ownership, technological changes of the product. We have to analyze everything else as well. Overall economic analysis of the company and of the industry.